All right, let's jump right in. We all know the term ESG screening, right? It's that basic idea of filtering investments based on environmental, social, and governance stuff. But honestly, if you think of it as just a simple in or out checklist, you're barely scratching the surface. The reality is, how you apply these screens has to be way more nuanced. And it changes, really changes, depending on what you're actually investing in. And that's exactly what we're going to unpack here. So that brings us right to the heart of the matter. The question anyone in this field has to ask, is a simple screen really enough? In a world full of complex strategies, all these different asset classes, can a one-size-fits-all approach actually work? Can it truly capture the risks and, just as importantly, the opportunities we're trying to get a handle on? Well, the short answer is nope. The long answer is what this is all about. Okay, so to get us started, let's look at the most common, the most classic example of ESG screening out there, the energy exclusion case. It's a perfect baseline before we get into the more complex stuff. This is pretty much square one for a lot of ESG-focused portfolios, right? Just exclude companies involved in fossil fuels. Seems simple, it's a clear, values-based decision, and it's become a real hallmark of sustainable investing. But, and this is a big but, the financial and strategic ripples from this one move are anything but simple. Now, check this out, because this is where it gets really interesting. If you're running an S&P 500 equity fund, kicking out the energy sector might not feel like a huge deal. It's less than 5% of the index. But then look over at the high-yield bond market. Whoa. The energy sector makes up a massive 13% of that index. And you know why? It's because a lot of the smaller energy and pipeline companies, they lean heavily on the debt markets to get capital. So a simple exclusion here, it's not just a little tweak, it's a major strategic bet. And that's the thing. This isn't just about values. It's a huge portfolio construction decision, and it has real-world consequences. First off, you're baking in some serious tracking error, which just means your portfolio's performance could swing pretty wildly from its benchmark. And second, just think about what happens during geopolitical events. When a conflict somewhere sends oil prices soaring, the energy sector often takes off. By cutting it out completely, you're choosing to sit on the sidelines for that potential rally, and that creates a very, very specific risk profile for your portfolio. Okay, so we've seen how complex it can be in just traditional assets. Now let's wade into some deeper waters, screening for alternatives like hedge funds, where, believe me, the rulebook is totally different. And this comparison just lays it all out perfectly. For your standard long-only fund, you're either kicking companies out or tilting your portfolio toward the ESG leaders. Pretty straightforward. But for a long-short hedge fund, well, screening becomes a two-way street. You can use a positive ESG screen for the companies you're buying, your long positions, and then you can use a negative screen for the companies you're shorting. It's brilliant, really. It lets you not only invest in the winners of the sustainable transition, but also potentially profit from the laggards who just can't keep up. Of course, saying it is one thing, doing it is another. The world of alternatives can be notoriously opaque. Hedge funds, unlike public companies, they don't always lay all their cards on the table and show you their holdings. And the assets they hold, especially the private ones, often lack any kind of standardized ESG data. What this means is you can't just plug in a third-party score and call it a day. No way. You have to roll up your sleeves and do the deep, fundamental, qualitative work yourself. All right, let's shift gears again and move into the tangible world. We're talking about ESG in real assets, things like infrastructure and real estate. And here, the whole game of challenges and opportunities takes on another dimension. The absolute game changer here is one word: control. Think about it. As a shareholder in some massive public company, your influence is, let's be honest, pretty limited. But if you own a building or an infrastructure project, you have direct control. You're the one who decides to retrofit for energy efficiency or improve water management. Now, that high level of control comes with a trade-off, a major data challenge. You just don't have the same public standardized reporting frameworks, so you often end up having to build your ESG assessment right from the ground up. And that is precisely where a tool like GRES becomes so incredibly important. GRES, the Global Real Estate Sustainability Benchmark, was literally created to solve this exact problem. It provides a standardized playbook for measuring and reporting ESG performance in real assets. It lets investors benchmark their properties against their peers, track key performance indicators, and really get a handle on their portfolio's total environmental footprint. It just brings a much-needed structure to what can be a very unstructured space. So we've looked at stocks, we've looked at hedge funds, and we've looked at real estate. And even though the screening methods look totally different on the surface, the goals underneath are pretty much the same.
Let's pull all these threads together now and look at the bigger picture of risk, return, and what we're all trying to accomplish.
So here's the bottom line. Every single sophisticated screening strategy, it doesn't matter what the asset class is. It's ultimately about managing two sides of the same coin. On one side, you're playing defense. You're managing downside risk, screening out companies with poor practices to sidestep regulatory fines, reputational disasters, or stranded assets. And then, on the other side, you're playing offense. You're actively trying to capture upside opportunity, finding the innovators, the problem solvers, the companies that are best positioned to not just survive, but to thrive in a more sustainable economy. And all of this leaves us with a really important question for the future. We are fast approaching a world where ESG data is just everywhere. It's becoming a commodity. So as the data itself gets easier and easier to get, the real challenge and the real source of value starts to shift. The next frontier isn't going to be about finding the data. It's going to be about how you integrate it, how you translate it into a winning strategy, and ultimately what kind of impact you can create with it. Definitely something to think about.